November 9th, 2023, 70% of outside down days are going to close in their lower third. And you can see today that happened. An outside down day is when you trade above the prior day's high, like we did on the open. And you also trade below the prior day's low, like we did here. So today was an outside down day. And same thing with outside up days. 70% of outside up days close in their upper third. So that's just something to keep in mind when the market goes outside down or outside up. Additionally, we got obviously a big surprise on 43 and 44. And bar 43 itself was pretty much the size of the entire day. Whenever you get something like this, you should just think of it as the day restarting. Because when you get such a volatile move, it's kind of the same thing like bar one. When you get bar one, the prior day's price action in the context matters a lot, but it is a new day, so anything can happen. And over here, when you get this, obviously the context matters, but it's a brand new day at this point. Pretty much anything can happen. You could look at it as a triangle, but the most important thing is when you get a massive surprise that's this big, like 43 and 44, you should just reflexively be thinking about the measured move. Because when you get such a big surprise, a lot of times, especially if it goes in the direction that the surprise was, you're going to get a measured move down of the surprise. And that's exactly what we got today. Bar one is a big bear bar closing near its low. And usually when you have pretty much any given bar or any given bar one to start the day has about a 20% chance of being on the high or the low of the day. But in certain contexts, it can be as high as 30%. And I think today is one of those days where bar one had a 30% chance of being the high of the day. Why? Because we're gapping up above the top of the trading range and we're pretty overdue for a sell-off. We're expecting a couple of days pullback on the daily chart. And this looks like it's the start of that. And when you get such a big bull bar on bar one, such a big bear bar on bar one, makes you have to start wondering, is this going to be a bear trend day? We're overdue for a pullback. So I think the context was correct to think that bar one had a 30% chance of being the high of the day rather than 20. And you get follow through on bar two. Follow through is decent, but it's right on the moving average, right near yesterday's close. And quite frankly, bar two is just not big enough. If I sold below bar one, I wanted to see bar two be a really large bear bar closing near its low. And it's a decent bear bar closing near its low. It's a reasonable sell, but being right on the moving average and being not that big, you should be comparing it to the size of bar one. If this is going to be a big bear trend from the open, bar two should be about the same size as bar one, and it's just not. And that's why there's buyers below two during three. Bar four, you can consider the second leg down. So one, pull back two. Pretty reasonable. And when you start to get this after this, if you're selling below two, what are you hoping is going to happen? You're hoping you're going to get massive follow through and a big sell off so you can make a swing profit basically early in the day. Traders who sell below two know that's probably not going to happen because there's an 80% chance you're going to get a minor reversal on the open. But that's what they're hoping is going to happen. And when you get 3 and 4, they start to realize it's probably not going to happen. And a lot of those traders start to scalp out. And that's what's causing the rally on 5. Follow through for the bulls on 6, but there's a lot of problems with buying above 6. First off, the tail on 5. So it could be 1, pullback, 2. So it could be a second leg trap. And additionally, it's an actual second leg, 3, and then 5 and 6. So it could look as a 2-legged correction from 1 and 2. Low probability buy above 6, I think. And that's why you get a big outside down bar on 7. So essentially 5 and 6 nested second leg trap. 7, big bear bar closing on its low. I think it's a good swing trade. It makes the market very clearly always in short. We were probably always in short here. And I think on 6, bulls needed one more bar to get the market always in long. Generally in a trading range, when you need one more bar to make the market, it's always in long or short, you're not going to get it. And when you get this big outside down bar on 7, it's not really disappointing to the bears. It's a really good bear bar. So it's a reasonable swing sell. The only problem with it is you're selling at the bottom of a potential trading range, but I still think it's a good sell. Follow through on 8 for the bears, but it's kind of disappointing. It's a big bear bar, and that's good, but it's not as good as it could be because of this tail on the bottom. And now you need to be thinking about, well, is this going to be a trend day or a trading range day? If it's going to be a trading range day, the bulls who bought below 4 are probably going to be able to scale in lower and make money. So when you get the reversal up on 9, a lot of traders are thinking, well, we're probably going to let those bulls make money. I think a lot of bears might exit above 9. You probably don't quite have to, but it's probably smart to exit above 9 and look to sell again below a bear bar. and you do get that bear bar on 10. And it's notable that, it goes exactly to the 4 low, but it does not overlap it, which means that those bulls, a couple of, maybe 10% of them got their orders filled. Usually if it touches it but doesn't go one tick past it, only 10% of traders are going to get their orders filled. So for the most part here, traders are trapped in. And I think it's a reasonable sell below 10, looking for a second leg, but you're pretty much selling on a channel line, which is kind of the problem with it. That the downside is probably limited because 6 and 7 is the spike, and now you're in the channel phase. What's the market cycle? It's spike, channel, and then what? Trading range. So overall, expecting a trading range, but definitely I think still a reasonable sell below 10 if you got out above 9. Bad follow through for the Bears on 11, but not the best close for the Bulls. Some traders might exit above 11 if it trades above. It's a tight trading range, and that's why Bears sell the close, trying to make sure it doesn't trigger, and we get bear bar on 12. Some bulls might have been front running 11, hoping we were going to get a strong close, and they were disappointed in the close, and they're selling out of their longs, causing 12 to trade down. Follow through for the Bears on 13. It's a good looking bear bar, but you're kind of, we're pretty deep in this bear trend at this point, and it's kind of a wedge. I think it's still okay to hold short, but you got to be pretty quick to get out. Because rallies can happen really quickly, as we see. And think about if you sold below 13, you probably have a stop maybe up here. Think about how you feel when you see 14. You're really disappointed in 14. So what happens on 15? Well, you sell below 13, you're disappointed in 14, and when 15 trades down to your entry price during you sell below 13, your entry price is down here, disappointed in 14, and you're exiting during 15, and that's causing the rally up on 15. I think 15 is an okay buy, but you have to keep in mind it's an inside bar, so it's probably an okay buy, but it's also probably a minor reversal with how strong this bear channel has been. It's not a very strong bull channel, but it's steep enough for a second leg, I guess is what I should have said. So I think 15 will be a minor reversal. I think the 6 low is a reasonable profit target because the bulls who bought below 6 got trapped on 7 and 8, and they were never let out. Additionally, the 6 close is probably a reasonable profit target as well because there are traders who bought that close and immediately got trapped, and they haven't been let out yet. And they probably should get out around break even if this is a trading range day. And judging by this price action, these strong bull closes, and this strong bull close, it probably is going to be a trading range day. So you can see when we got back up to that 6 close, a lot of those traders who sold, or who bought, sold out of their longs. And that's why we started to find selling up here. And 16 is interesting. It's now an inside pattern, 15 and 16. So it's an II pattern and it's still a reasonable buy, I think, above the breakout. Or above the breakout point of the II. So you could buy above 15, you could buy above 16 on that same premise. Basically, 15 and 16 is just contracting, right? So contracting just means it's a triangle. And the more inside bars you get, usually the bigger the breakout's going to be. Like over here, we got an I pattern, which is pretty unusual. And it led to a pretty big move. 17, follow through for the bulls. We're kind of headed towards the top of what could be this potential trading range. It's basically the top of the channel, right? Because we got a spike and then a channel, and it's turning into a trading range. So the market often tests the top of the channel, and that becomes the trading range. But we got kind of a disappointing tail on 17, kind of disappointing tail on 18, which happens in trading ranges a lot. It's that the market doesn't quite do what you want, and that's how it keeps traders out. And by the time you get a good bull bar to buy above on 19, you're pretty much, you're right next to the profit target. So your reward is not as good. And you're buying higher in the trading range, so it's a little bit concerning. It's probably still a reasonable buy the close bar on 19, but you have to be keeping that in mind when you get 19 that you're buying kind of high in this trading range now, and you're buying right where bulls are going to be selling. Good follow through for the bulls on 20, trying to get to this 6 close, but the risk reward is not all that good anymore on the 20 close. Something else to keep in mind is there's a 90% chance we're going to break out of the 18 bar range, and we haven't done that yet. So some bulls were buying above 19 on the premise that we're going to get all the way up here. I think that's a reasonable thing to do. 21, disappointing follow through. 22, you can see we got back to that 6 close and found sellers. Buyers below 22 during 23, but you're at the top of the trading range, so the pullback could be rather deep. Something else to note is that the bears who sold above 16 did a reasonable thing selling above the bear bar. So you have to be wondering if we're going to get back to that 16 high at some point today. The same way that the traders who bought the 6 close did a reasonable thing. It wasn't a great thing to do, but they did a reasonable thing, so they should get out of break even. Not a great thing to do to sell above 16, but some traders do it because it's reasonable, and so they should get out of break even. 24 bear bar closing near its low, but this is a tight trading range, and this spike is really strong, so I would be careful selling up here. 25, it's a good bull bar, but if you're buying above it, you're buying at the top of the trading range. And I don't think this pullback has gone on long enough with, how steep this was. I do think we're going to get a second leg up, but I'm not sure when it will be. I don't want to buy the top of the tight trading range on 25. Why? Because this happens a lot. You get bars like 26 where you get really quickly trapped and you can easily take a full loss on the trade. Didn't end up going outside down on 26, but it's a decent bear bar. So, but it's notable that 26 was not able to close on its low. If it was able to close on its low and maybe break out by a tick or two of the tight trading range, some bears would take the short, hoping we were going to get to this high, but we weren't able to do that. 27 is an interesting bar. It's a really small bar, and you're kind of buying a little bit lower in the tight trading range than you'd normally be forced to. So that's good for the bulls. And if you notice, you're only risking 2.25 points, maybe 2.75 because one tick above and one tick below, but you're trying to make almost 10 points. So you get 3 or 4 to 1 risk reward buying above 27, expecting a second leg up from 17 to 20 and hoping that it's going to break out above the one high. So I think it's pretty reasonable to buy above 27. It's just lower probability because the bar is so small. If you want higher probability, you would wait till we get a breakout above 22, since that's where the top of the tight trading range is, right? Since this is the tight trading range. Traders who buy above 27, what do they want to see? They want to see 28 be a breakout above the high of 22. 28 is a good bull bar, but it doesn't break out above that high. So it still leaves you wondering if traders are going to scalp out. And you can see that's what they start to do on 29. We started to get a breakout above that high, but traders started to scalp out. And that leaves traders wondering if we're going to get any follow through. If you buy above 27, what did you need to make a 5-point scalp? You needed the market to go 22 ticks. So it's 4,400.25, and you needed to go to 4,405.75. Look, it goes to 4,405.5. So those traders were trapped out from making 5 points by 1 tick. And they got trapped out from making the 5 points, and then they got this tail on the bar. And a lot of traders are thinking, well, it's a trading range, and the market can get vacuumed back down pretty quickly. So what are they going to do? They just start selling out of their longs, and that causes the drawdown on 30. But bulls will buy this high. Oftentimes, break-even stops get run. And if you had a break-even stop at the high of 27, that stop got run, and that's why you ended up getting this, rally back up on the 30 tail. Inside bar on 31, but a doji, bad follow through on 32. Any bulls who are buying, hoping for another leg up are going to be obviously disappointed in 31 and 32. So a lot of them sell out of their longs, causing 33. We are at the top of a trading range. So you have to be wondering if we're going to get a swing down. And additionally, if you're wondering if we're going to get a swing down, what's the profit target, right? Well, I think the 16 high is a pretty good profit target if we're going to get a swing down, because there are traders who are trapped out, who sold above this, who are still trapped. And does this look like a strong bull trend day to you? No, not really. So it's more likely a trading range day. And if it's a trading range day, these traders should be let out at break even. And at this point, you have to be thinking, well, if we get to the 16 high, what else are we probably going to do? We're probably going to break out of the 18 bar range because there's a 90% chance that happens. So it's reasonable to think that if we get down to this high, then we're just probably going to get below 15 as well. Follow through on 34. Notice 33 had a tail, which is disappointing for the bears. 34 is a strong bear bar closing near its low, but it's kind of similar to 2 in that I want 34 to be larger. I think 34 is still an okay swing trade, but I think in general, you want 34 to be a larger bar with, somewhere down here maybe. Just a couple extra points to show more conviction for the bears. You get disappointing follow through on 34 or on 35, which is pretty common in trading ranges. In a second leg down on 36, I think it's okay to hold short. Bears are wanting to get stronger follow through at some point. And you get another disappointing bar on 37, but it never trades above it. So always in bears, still no reason to get out. And then and then a big bear bar on 38. When you get 38, the problem with it is it's one push, pullback, second push, pullback, third push. So it's a third push down in what might be a trading range. But I think it's reasonable to stay short, hoping that we get a breakout below the flag in a measured move down to here, which essentially is the bottom of the bull spike, where there are usually buyers. And then bears willing to sell below 38, but you get a super disappointing bar on 39 that doesn't even trigger the bears below 38. The always in bears have to get out below above 49 or 39. I would say probably. You might be okay to hold, but at this point, this is an expanding triangle, which could be a final flag for the bulls, but I think it's better to get out and wait to sell below a bear bar. Usually, this is obviously really unusual. Usually you'll get a strong bear bar closing near its low that you can sell. You can sell below again. If we're going to end up getting a move down to the low, you'll get a good bear bar that you can take the short. And bears covering shorts causes 40. You get some follow through for the bulls on 41, but there's a tail on 40 and a tail on 41. So it makes you wonder, how further up is this rally going to go? If you're buying above 40, you're hoping that we're going to at least get to the top of the expanding triangle and probably break out of the 18 bar range. And if that's going to happen, why are we getting a doji bar on 42? That's really disappointing. And then obviously you get 43. And 43 resets the entire day. Once you get 43, it breaks out of the 18 bar range. It lets these bears out. So, all that pretty much goes out the window. And I had a point I was going to make. It just slipped my mind. But whatever. And then you get more follow through for the bears on 44. This is obviously strong enough for a second leg down. And again, when you get something this big, you should be expecting a measured move. And then you get disappointment on 45. What is 45? Well, it's about a 50% pullback of the spike, in that area, which is pretty common when you get something this big. Bears are going to sell the 50% pullback because it's more likely that you get another leg down than it is that this rallies straight up. Inside bar low 1 on 46, maybe a reasonable sell, but this is steep enough for its own second leg up. And you can see that's what happened on 47. We trade back to the 45 close. So the bulls who bought the close of 45, disappointed 46, are getting out during 47. 48 now is an I pattern, and I think you can take the swing sell below 48. It's not amazing. It's okay to wait for follow through as well. Generally once you get an I, there's a 50% chance that we're going to get a breakout down, a 50% chance we're going to get a breakout up, and a 50% chance that the first breakout is going to fail. You get disappointing follow through on 49, so the first breakout appears to be failing. Bulls are hoping that we're going to start to get a breakout to the upside. A lot of traders would argue that the sell is below the breakout of the actual III, and the buy is above the top of the III. So it never actually triggered during 49, but I think that this qualifies as a failed breakout. Bulls now want to drive the market up and get a strong close above here and probably get back to the 42 low, hoping that this is a trading range day, which is a valid premise. But it's a bear bar on 49, so that's kind of a problem for buying above. And that's why you get disappointing follow through on 50. Not many bulls buying above 49. Why? Because it's a bear bar, and if you're going to get up here, you're going to get a good bull close on 50, and it's much higher probability to just buy above the good bull close than just to buy above the bear close. I think 50 is a credible swing. It's a bear bar closing near its low. We're probably at least getting here. And at this point, you got to really be wondering if we're going to go outside down. This is forming like a day that's going to go outside down. And we got so close to it on 44 that you might think we might have to test that magnet. If you do sell below 50, you get decent follow through on 51. But it's not everything you want. But it's because there's a tail on the bottom, and that's because you're touching the 45 close where some traders are going to buy back their shorts. And then you get 52, obviously some profit taking here. The bears have to exit above 52. It's kind of tricky. It is a double bottom, and you're risking that this is the bottom of a trading range. And occasionally on 53, you're going to get a decent bull bar. But this is going to happen enough of the time that it's okay to stay long above 52. Maybe you could get out a couple points above 52. You could have a stop around break even if you sold below 50. I think that's okay, because if it trades all the way up here, then you're going to get a bear bar closing near its low if we're going to go down. So we end up getting an outside down bar on 53, a reasonable sell. It's potentially a second leg trap, but I think that the market is overall more bearish at this point, and you can be short and just exit above any good bull bar. Doji bar on 54, disappointing follow through, and then a big bear breakout on 55 that breaks below yesterday's low. What I think is important here is the market cycle, because you had a spike and then a pullback and then a channel, and the market's now going to try and form some kind of trading range. And when you have, sorry, I had to pause for a second to grab some water, but I believe what I was saying was talking about the market cycle. So when you get this, it breaks bar 55, it breaks below yesterday's low. And so now you don't really have the premise of today will probably be an outside down day, because it is now an outside down day. So that premise it's already done. Um, and what bears are hoping for, when you start to get a sell off like this and the bars, get a lot bigger and increase in volatility, bears are hoping that we're going to get one of those days where there's just a massive crash at the end of the day, which will occasionally happen. But if it's going to be such a massive crash, why are there bars like 52 and 54? Why are there doji bars? If you're going to get a massive crash, you're going to get consecutive strong bear bars. Bars like 1 and 2. If let's say that, bar 51 looked like bar 1 and bar 52 looked like bar 1, then bears are going to be thinking, well, we're probably going to go down for the rest of the day. But when you're getting these doji bars, bears are like, well, we're outside down now, but how long is this going to go? Because you have these trading range bars, and the bulls who buy below 54 are probably going to make money. And you can see those bulls do make money on 60. So traders, will have, so to speak, a shorter leash for the market, because they're worried that, they want to protect their profits, and they're worried we're going to end up getting a rally because of all the trading range price action in here, 52, 54. These dojis are trading range bars. So you have to be worried that the market's going to end up forming a trading range. And when you get bad follow through like 56, it's the same thing. I think a lot of bears would exit above 56 had it triggered. And I think that's one of the reasons it didn't trigger. It's because bears sold the close of 56, hoping that it wasn't going to trigger and that they could get another leg down. 57 is an inside bar and a bear bar closing near its low. I think it's probably an okay swing sell, but you're really deep in this bear trend at this point. So not really sure how much is left on the bear trend. And I don't know if they got a 5-point scalp, 68.5. So it needed to get to 63 flat, and it came up 1 tick short. So same thing as up here. It's a 21 tick trap. And once the bears got the 21 tick trap, a lot of them, they have basically no true risk selling below 57. The tail on 58 is minor. And you can see on the close of 58, those bears have an open profit that's pretty much exactly 2 to 1 of their true risks. So what are they going to do? They're going to take profits, and that's what's causing the big bull bar on 59. And these bigger bars happen in trading ranges more frequently because traders will be quick to take profits, versus trends. Traders will be slower to believe that the market's going to reverse. And then traders, especially on the close of 59, as 59 is racing up, even traders start to realize that we're probably getting back to the 54 low, and we do on 60. But if you bought the 54 low and you got this, how do you feel about your trade? Probably not very happy. You're probably pretty relieved to be able to scale in and make money. So I think those traders will be exiting their longs, and that's what's happening on 60. Always in bears are probably out a couple points above 58. Or, if you traded it literally, your stop was probably above 56 and you got stopped out. Or, you got stopped out above 59. But either way, always in bears are probably mostly stopped out. And I think that makes 61 a credible sell. It's a 3-bar reversal. And you could take the sell below 61, hoping for another leg or 2 down. Good follow through on 62, but bears end up scalping it. I think they made 5 points. So it's at 69.5. So it needs to get to 64, and it got to 63.25. So bears were able to make 5 points, and the market pulled back. And then we got another leg down 63. So it could be 1 pullback 2, and this could be a second leg trap. So some bears are taking profits, and that bulls who bought below this low are probably going to be able to make money, and they are able to on 64. I don't think they made 5 points, but they were able to make money. Yeah. 60, bears, always in bears, definitely going to exit above 64. So what do? They sell the close of 64, try not to let it trigger on 65. But at this point, bears are this is pretty overdone. We had the spike on 44 or 43 and 44, and then we had the pullback, and obviously we're in the channel phase. But the reality is this is probably going to convert into a trading range pretty soon. And so, and when you're getting these big bull bars like 59, 64, it's more and more likely that this is going to end up converting into a trading range. And that we're going to test the top of the channel. And I think, it's reasonable to think that tomorrow we're going to test up here somewhere. Tomorrow I'd expect 2 hours of sideways to up trading. In general, I'm on bar 66, I believe. But in general, actually, I'll talk about the daily chart in a minute. I'll just finish this up. 66 bull bar, okay close, but not really worth exiting above. Some traders will because this is pretty overdone and they just want to take their profits. 67 outside up bar, but disappointing close. 68 inside bar. Traders might start exiting, but I don't think you necessarily have to. It's a double bottom, but you should probably exit above 68 and look to sell again because this is so overdone. And the later you are in the channel, the more tight you should be with your stop. But some traders will keep their stop above 64 and they don't get run on 69. But probably buyers below 69 during 70. You can see there was. And then we pretty much just started to go sideways into the end of the day, and we tested back down to the new low. But I think 60, once we started to get down here, you had to think we were probably going to get to the measured move, but probably not much further down than that. On the daily chart, this is a big bear bar, and it's essentially a double top with, the 13th. But I think that this is going to be a minor reversal with how strong this is. So probably expect 10 bars or 2 legs sideways to down, and just overall relatively disappointing follow through, I would say. We might get a bear close tomorrow. It wouldn't surprise me if we get a bear close tomorrow, and if we get a couple, drifting sideways to down bear days, and just kind of a 2-legged correction. Maybe, we might get a deeper pullback to, we could get all the way into here, I think, towards the 50% correction of this whole move. But I think in general, it's safe to assume we're going to get 2 legs sideways to down, and then bulls are definitely going to try to get a second leg from this really steep move and maybe try to get somewhere up here. But I think they'll definitely try to get up above this high. The weekly chart, I've been saying, I think the bulls are going to get disappointing follow through, and I still think that holds true. I think this is going to end up. It wouldn't surprise me if this ends up being a bear close. We only got 1 day left in the week, so pay attention to the open of this bar tomorrow, because bulls are going to try and drive the market back up to this open and get a bull close on the week. I think regardless of if it's a bull close or a bear close, we're probably going to get more disappointment for the bulls next week. But if it's a bull close, there's a low probability that we're just going to get a big bull bar next week and race somewhere up here. And if it's a bear close, it makes it more likely that if something like that happens, it's a second leg trap. But regardless of what this bar ends up looking like tomorrow, I do think that we're going to continue to go sideways to down and try to test this high. Yeah, that's pretty much